Welcome to The Income Generation, the show where we share valuable financial information for that critical period in life when you're either in or approaching retirement. If you're tuning into the show for the first time, I have to be honest, you picked probably the perfect episode. Why? Because today's topic is honesty, and I happen to believe that honesty is the first essential step towards sound financial planning. And it all begins with recognizing that successful saving and investing is as much an inside game as it is an outside game, which is something I talk about a lot in my upcoming book, Return on Principle: 7 Core Values for Protecting Your Money in Good Times and Bad. You see, the outside game is what 99% of those market analysts and financial celebrities on television are focused upon, telling you which stocks to buy, where interest rates might be heading, which mutual funds are hot, and so on and so forth. That's part of the outside game, and approaching it with complete honesty is important, as I'll talk about more today on our market breakdown segment. But even more important is acknowledging the inside game, the reality that your success or failure with your money depends in a large part upon who you are as a person, how you're wired, your cumulative life experience, your personal goals, your education, as well as your professional background, and most importantly, it depends upon making the effort and having the ability to be brutally honest with yourself. Specifically, that means looking inward to determine if you, yourself, possess those 7 core principles necessary to protect your money and achieve your financial goals. It also means measuring your advisor with the same level of honesty and scrutiny to determine if he or she possesses those necessary qualities. That's crucial because, as I've talked about on previous shows, no 2 financial advisors are created equal. Some understand the inside game and possess the proper core values, where some simply don't. But you shouldn't assume anything because your life savings is too important for assumptions. You need to know, not assume. In upcoming shows, you'll learn how to honestly examine yourself for all 7 core values. Next week, for example, we'll focus on diligence. Are you someone who enjoys doing your own investments? And if so, are you willing to buckle down and really devote the time and effort necessary to doing it right? Are you willing to blow off a golf game if that's what it takes to be diligent in managing your own money? And even if you have the diligence, do you have the necessary level of detail orientation, which is another core principle we're going to be talking about in a future show? Are you willing and knowledgeable enough to look past the star rating on your mutual funds, for example, or beyond the Moody's or Standard & Poor's bond ratings on your fixed income investments? And in essence, scrutinize details at a deeper level? Are you detail-oriented enough to pay attention to those things, or do you get anxiety just thinking about all the details because you're more of a big-picture person? Again, an honest answer is vital. When it comes to the next principle, coachability, are you coachable? Even if you believe something very strongly, if you are subsequently presented with a preponderance of evidence that your previous beliefs are perhaps wrong, are you coachable enough to accept the evidence and make a change? Do you possess the other core values necessary to protect your money and make it work for you, such as leadership and fearlessness? In other words, are you willing to take a different path as a leader would when you realize that all the talking heads on Wall Street are selling you their agenda instead of what's really right for you individually? And if so, are you willing to stray from the pack and take the road less traveled? Or are you the kind of person who simply doesn't feel quite comfortable unless you're with the majority? You see, the inside game really boils down to the simple but profound words of Socrates: know thyself. I believe that's invaluable advice for investors. But you should also understand that not being honest with yourself doesn't necessarily mean that you're being dishonest. More often than not, it simply means that you're making assumptions about yourself, or that you have a tendency toward wishful thinking and optimism. In fact, you might simply be hardwired to be an optimist, which is a great quality in life in many ways, but can also get you in trouble when it comes to your money. And again, it's possible that your financial advisor is wired in that same way. Or it's possible that he intentionally ignores the inside game because it's more convenient and perhaps more profitable for him if you don't know yourself, but just blindly follow his narrow guidance instead. So again, you shouldn't assume anything. You should make the effort to know for certain whether he or she possesses the core values really necessary to protect and manage your money. So on today's show, you're going to learn a lot more about this and about all the areas in which the first core value, honesty, is essential in financial planning, and how to honestly examine your many different options. Let's start by taking a look at where things stand with today's economy and financial markets, and how this part of the outside game ties directly to the inside game, coming up next in our market breakdown.
Read David J. Scranton's groundbreaking new book, Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Available now.
As we tape this show in mid-April, some recent reports have suggested that the United States is in the midst of a period of historic job growth. Supposedly, we've had a record 73 straight months of private sector job growth, and according to the Bureau of Labor Statistics, job growth in the last 3 months has been the strongest of any 3 months since 1983. Sounds like great news, right? Well, certainly it should be. Just like reports about the housing market finally starting to come back after its historic collapse in 2008 should also be good news. These are some of the most important leading economic indicators, and the fact that they're reportedly moving in the right direction, and have been so for some time, should make everyone happy, including business owners, consumers, politicians, and investors. But let's all be honest with ourselves. Does anybody really seem all that happy or optimistic about the supposed economic recovery? How do you honestly feel about the supposed recovery? In fact, just look at how much anger there seems to be on display in this year's presidential election. Consider that despite all this optimistic news about jobs and housing, the stock market has been basically stagnant for nearly a year and a half. Actually, stagnant is the wrong word because it has also been rocked by record levels of volatility, including a historic plunge last August that capped off with the Dow plunging 1,000 points in a single day. Basically, though, its upward momentum stopped right after the Federal Reserve's quantitative easing program stopped in October of 2014. And right now, after posting a rocky first quarter, and frankly, its worst January in history, the market is down about 3% from where it was just 1 year ago. So where's all the joy and celebration over this economic recovery? Well, to answer that, you need to look beyond the numbers in some of these more optimistic reports. You need to be brutally honest with yourself and consider the inside game in addition to the outside game. Remember, numbers are only part of the equation when it comes to the economy and financial markets. In fact, there are a lot of social and emotional factors to take into account as well. So when you hear things like 73 straight months of job growth, you probably shouldn't take that at face value. When you hear that the unemployment rate recently fell below 5% for the first time since 2008, you should take a look beyond that number and be brutally honest about whether it really reflects a healthy and growing economy. Massive job loss was a major factor in the Great Recession. So the unemployment rate has been watched very closely throughout the recovery. And while the numbers, yes, look a lot better than they have in a long time, they are skewed by changes that have taken place in the workforce in wake of the recession, most of which are not positive changes. For example, one is that the labor force participation rate has dropped to its lowest level since the 1970s, with only 62.7% of American adults working. A major part of that reason is that many people have just given up trying to find work. The Wall Street Journal recently estimated that about 2.6 million of the 9.2 million Americans out of work still want a job, but stopped looking for one. I take that as a sign that the market is still frustratingly tight, at least for decent paying jobs, which is probably because a huge percentage of employers have not increased worker salaries in years. This was actually a problem before the Great Recession came along, but it's only gotten worse since. In fact, according to one report, the average family income today is no higher than it was in the year 2000. Think about that. Another sure sign the job market is still tight is the fact that long-term unemployment is still alarmingly high. In fact, an estimated 2.1 million Americans actively looking for work have been unemployed for at least 6 months. And that is not a very healthy number. So when you go beyond the numbers and take an honest look at all the contributing factors, you can begin to understand more and more why this recovery simply doesn't feel like a recovery, even though a lot of elected officials and Wall Street cheerleaders try to spin it that way. I single them out particularly because they're among the people and institutions that have a vested interest in making you feel good about our economic state. The politicians who've been working on the recovery, of course, want to be reelected. So it's their interest to make you believe they've done a very good job. Wall Street CEOs, on the other hand, and some brokers, want you to focus just on the positive numbers. Why? Because they want to keep you invested in their products, primarily stocks and mutual funds. And of course, when are people more likely to invest and reinvest in the financial markets? When they're pessimistic and think the economy is spiraling downward, or when they're optimistic and they think the economy is getting stronger and stronger? Obviously, it's the latter, not the former, which is why Wall Street and so much of the financial media always wants to paint such a rosy economic picture. That's why it's so important to look beyond the numbers and to question everything you read and hear. Be brutally honest with yourself about whether or not it conforms to your own observations, your own experiences, and to your gut instincts. This is another important mechanism we all have for gauging honesty. I call it the Sniff Test, and I apply it to just about everything I come across that just doesn't quite feel right. Now, I know that some people are more trusting than others, of course, but each of us has a certain level of healthy skepticism. You should never ignore yours, especially when it comes to anything having to do with your money. In fact, at the end of the day, I believe this is probably the main reason this recovery seems so muted, why voters seem so angry and investors seem so hesitant, even nervous, despite some occasional good-looking economic numbers. For a lot of people, I'm guessing none of those numbers pass the Sniff Test. They run counter to what a lot of us are experiencing when we pay our bills or go shopping or talk to friends and neighbors. In fact, I know it's true of me. I personally have offices in Fort Lauderdale and the Shoreline in Connecticut. And in those places, you actually can, in fact, see signs of a housing market recovery. But I also travel to visit some of the advisors with whom I work across the country. So I know that the picture looks dramatically different in most places. Depending upon where you live, the housing market might still look dismal, which isn't surprising when you look and align yourself with those details behind the jobs numbers. I've explained in previous shows why I believe this so-called economic recovery has never felt quite right and why it still doesn't pass what I call the Sniff Test. In essence, it's because our government resorted to untested and unprecedented measures in trying to achieve it. Through 4 rounds of quantitative easing, the Federal Reserve was given a free hand to try to artificially stimulate spending and growth. Now, not surprisingly, a lot of the results feel artificial. That goes for those rosy economic numbers, and it goes for the stock market as well. In fact, the market's recovery since 2009 has been real enough. But based upon what? Most people believe it's not based upon economic fundamentals, but on the artificial influence on quantitative easing. The Federal Reserve printing money, buying back bonds, and driving everyday investors up what we call the risk curve by holding down interest rates. The result was recovery, all right, but not so much in economic recovery, but more so in asset recovery, with not much really substantive behind it. And as I pointed out, since QE3 stopped 18 months ago, the market stopped rising and has been stuck in a nervous holding pattern ever since. Even the 7% rise the S&P 500 saw in March was deceptive because trading volume in the month of March was actually the thinnest it's been all year. That very well could mean the rise was based upon just a handful of stubborn optimists trying to squeeze just a wee little bit more out of the market that might be on its last legs. Naturally, no one wants to hear bad news. We're all hardwired to an extent to want to hear good news. But that's why it's so vitally important to remember the inside game and to take the time to be brutally honest in how you process all the information and advice that comes your way. Question everything, look at the details, and give it what I call, again, the sniff test. Also beware that there are certain factors out there who actually want to take advantage of your natural tendency to hear what you want to hear. So in that sense, being honest with yourself is also your best defense against dishonesty. We'll be right back after the break with our guest. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation, again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. Our guest today is influential thinker, author, and economist George Gilder. He's co-founder of the Discovery Institute. He wrote the international bestseller Wealth and Poverty, a book that made him President Reagan's most quoted author. In 2013, he published Knowledge and Power, the information theory of capitalism, how it is revolutionizing our world. His latest book is The Scandal of Money, Why Wall Street Recovers, but the Economy Never Does. It's great to have him on our show. Thanks for joining us.
Thank you.
First, can you explain briefly the information theory and how you believe it impacts the economy and financial markets today?
Sure. The essential insight is that can be summed up that knowledge is wealth, and wealth is knowledge. Cesar Hidalgo, economist at MIT, put it this way. He said, when an expensive car crashes into a wall, all its information and value disappears, even though every molecule and atom remains. Value is information. Mm-hmm. The car is knowledge. Mm-hmm. And I've extended this proposition in my earlier books and in The Scandal of Money to all economic growth. If wealth is knowledge, growth is learning. And as we know from all the business consultancies, the learning curve is the most well-demonstrated phenomenon in business. With every doubling of total units sold, costs tend to drop between 20 and 30%. Learning is growth. Growth is accomplished by businesses performing entrepreneurial experiments. And they can only yield learning and growth if they can fail, if bankruptcy is possible. And so learning has to happen in a free economy.
Okay. So
and the scandal of money is that there's no measuring stick to judge the learning. The money has become chaotic expression of currency trading that is far less reliable and far more volatile than the actual economic activity it's supposed to measure.
How does this affect dishonesty, if you will, whether it's on the corporate level, Wall Street's level, or even the government's level in terms of how it reports statistics and the like?
Well, if the measuring stick is constantly distorted, all the statistics become what I call Pravda money. They're just a guess at what things might be worth rather than any measurement with a root in actual values in the world. And that's why since 1913, when the Fed was created, if you had $1 million of paper money, it would be worth $20,000 today. But $1 million worth of gold would be worth $60 million today. So gold holds its value. But what's happened now is Bitcoin has emerged mimicking gold. The Bitcoin blockchain allows the creation of a new 21st century kind of gold standard. And once again, we can have monetary values rooted in the real world rather than just notional values invented by central banks.
Certainly, certainly. You know, in the last 3 decades between the publication of Wealth and Power and Knowledge and Power, a lot has obviously changed. What do you believe is the most important change that everyday investors need to know about and understand?
I think the emergence of the information technology economy. All information theory is the foundation of the whole internet, computer science, and I believe it can be extended to all economic analysis. This is information theory that identifies information as surprise, as unexpected results. And the notion of information as surprise allows you to incorporate entrepreneurial creativity in an economic model. And, you know, creativity always comes as a surprise to us. If it didn't, we wouldn't need it.
Sure.
And socialism would work.
So in the last minute we have left right before the break, you know, how does the average person looking in this information age at the preponderance of information data available, how does this person know which information to focus on that is correct and which information not to focus on that might be marketing hyperbole?
Well, basically, information is unexpected development. So when you get numbers that diverge from what is expected, it probably signals some information being issued by the market. And that is the basic rule of information theory, that you have to really understand the specific companies. You can't measure the stock market with an oscilloscope measuring ups and downs of the overall market. You gotta look at individual companies with a microscope that can yield the surprising data that signals big new opportunities.
I've got you. Well, listen, we're going to take a quick break. So, George, I know you're going to stay with us. And for our viewers, you stay with us also. We have a lot more questions for George and a lot more about helping you determine how to be brutally honest with yourselves in managing your portfolio. We'll be right back.
the closing numbers on the markets today. At one point, the market fell as if down a well, over 700 points.
Apple shares were just getting hammered this morning.
We're down by between 3 and 4.5% generally across these markets. Let's talk about the speed with which we are watching this market deteriorate. We're red everywhere, essentially, down by 4-5%.
We're down over 16%. Dow at the same time has fallen about 18%.
The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
Finally, there is an alternative. Read David J. Scranton's groundbreaking new book, Return on Principle: 7 Core Values to Help Protect Your Money in Good Times and Bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. Learn the truth about Wall Street, the financial media, and the secrets they try to hide from everyday investors. This isn't just another book about investing. Working Americans who have lived through 2 major stock market crashes and the worst financial crisis since the Great Depression in the past 16 years don't need another book about investing. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Stop planning for retirement with your fingers crossed. Plan with confidence, knowledge, and peace of mind. Read Return on Principle: 7 Core Values to Help Protect Your Money in Good Times and Bad. Available now.
We're today with George Gilder, author of The Scandal of Money: Why Wall Street Recovers But the Economy Never Does, and overall well-informed investor and economist. George, you know, for the average American today, working just for simple goals toward a secure, happy retirement, do you believe that achieving that goal is more challenging today than it was for earlier generations?
I do believe that it's harder because of the chaos of currencies. Today, replacing any real standard of value is currency trading, and currency trading is now $5.3 trillion a day. That's 73 times all the world's production of goods and services. It's 26 times all world GDP. And it's a scandal of money because it doesn't even yield a reliable currency to measure the learning curves of the real economy. So, and the government, moreover, doesn't want you to buy anything that you know about. And it's the government believes that the best investment is the state lottery in general. And what's happened is that President Obama has combined with the Fed to effectively nationalize the banks, and through the banks, nationalize our economy. Mm-hmm. It's the major transformation that he promised, sure, and he achieved it to a great extent, and it makes all stock market values deceptive. It creates a closed-loop economy between Wall Street and Washington, mm-hmm, with Main Street shoved aside.
And of course, that's a great example of governmental dishonesty, you know, layered on top of the unprecedented levels of Federal Reserve influence and so on. But what would you say is the most egregious, more recent example of corporate dishonesty in general? And I'm not talking about specific corporations, but in general, the most egregious example of corporate dishonesty.
Well, I think it's enforced by the government. I think that this, you know, the behavior with real estate before the crash was a gigantic corporate deception inflicted on corporations by the federal government, by the FHA, Federal Housing Administration, by Freddie Fannie Mae and Freddie Mac, by the Community Redevelopment Act, all these massive programs dictating that banks invest the savings of America chiefly in real estate, which is, and so what we did was we bid up existing assets by borrowing from the future, by impoverishing our retirements and our children and our grandchildren. And that is a gigantic dishonesty, but it's a scandal of money that's enforced by the federal government.
And George, I guess you could say the same thing about today's unprecedented levels of corporate share buybacks, correct? Borrowing from the future to inflate values today?
Yeah, well, if 62% of the Fed's new money goes directly back to the federal government, 2/3 of the remaining money goes to the S&P 500, which uses it at a rate of some $25 to $30 billion a month to buy back their own shares and buff up stock market values, but not do real investment with a yield for the future. So I think that's a further scandal of money.
Yeah. Do you believe that a lot of this has to do with the government and Wall Street being too short-sighted when it comes to what's best for them or what's best for our country?
No, I think we have had a covert socialization of the American economy. The banks around the world have been assessed penalties and fees of some $300 billion. They can't move without consulting the government. And the government's zero interest rates zero out the future. When anything is free, like zero interest rates mean money is free, only the people on the front of the line get any. It has to be distributed by Q, as David Malpass said, and only the people in the front of the line get it. Main Street and even Silicon Valley is largely left out of the loop in this closed loop economy.
Now, as you know, on today's show, we've been talking a lot about the importance of honesty and saving when it comes to specifically retirement investing. So as someone whose work focuses a lot on ethics and morality, do you have any final closing thoughts or insights that you can share about this topic for our individual investors?
Yeah, I think that you have to understand that capitalism is not some arbitrary system. It's based on discovery of truth. And that's what the market does when it's allowed to function. It reveals the truth about business plans. It enables learning. And deceit is destructive to capitalism, and Pravda money is the form of money that the government is offering. They manipulate money to create an image of growth, but that is not translated into real yields in the future and real learning that constitutes growth.
George, we have to leave it there for now. I apologize. We are out of time, but I really want to thank you for being part of our show today. Thank you.
Thank you. I appreciate it.
And stay with us, because when we come back, Morgan and I will give you specific tips about how to determine whether you have the internal resources, teach you how to be brutally self-honest, to do your investing all by yourself, and or questions you can ask your advisor to determine if he has that sense of brutal self-honesty. We'll be right back after the break. If you're not using someone who's well-trained in fixed income and you're born before 1966, it may just be time for you to break up with that advisor and move on. I would suggest someone who will care for you through these important years of your life. If you need help finding someone, call or write us. I'd also like to remind you of the special report entitled The Income Generation. This is available free to you, our loyal viewers, online. If you haven't downloaded your report, pick it up after the show. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation, again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation.
Welcome back to The Income Generation. We're discussing questions to ask to determine whether you or your advisor possess the core value of honesty. And the first question to ask your advisor is, tell me of a time, in business or otherwise, when doing what you felt was the right thing might have cost you money, but you did it anyway.
Well, the first thing with all these questions for your financial advisor is to make sure that person is being brutally honest. So one of the things you want to look for is there a delay? Is there a delay between the time you ask the question and they give you the answer? The quicker the answer comes, it means that they weren't thinking about maybe covering up something that happened that was negative. And I talk about in my upcoming book, as you're well aware, Morgan, and also I talk about openly on television. One time in my career, very early on, when my firm, I didn't even make a mistake, it was my firm that made a mistake that cost my client a few $100s. My firm refused to fix the mistake. And I knew in my heart that the only right thing to do was for me to come up with the money to refund my client. Unfortunately, what I didn't realize at the time was the way in which I was refunding that particular client actually broke a FINRA and SEC rule. And I actually had a 10-day suspension for that. And it's actually the one and only black mark I have on my record in the spirit of trying to do the right thing for a client, but unfortunately doing it in the wrong way.
Wow. You know, and in the spirit of being brutally honest, that brings us to our next question, which is, tell me of a time when you had to be brutally honest with a client about a mistake. Maybe this is the right time to mention that, or for whatever reason, there was something difficult to communicate, and how did you do that?
Well, it's a great question to ask advisors, because if you think about it, if any advisor has 50 or 100 clients or more, and hopefully the advisors that you're interviewing do indeed have at least that many clients, you know that they've had some issues in those 50, 100 clients where things didn't go as smoothly as they were supposed to. And again, what you're looking for is the ability to be forthcoming, to quickly give you an answer and say, well, here's a time when something happened, and it cost my client money, it cost me money, and it was a mistake. And if you can get that quick answer, then that's a good sign. However, if somebody tries to say, well, we're perfect, we don't have any mistakes, you know, there's no office that I know of that doesn't make mistakes every once in a while. I mean, we're all human.
That doesn't sound like honesty to me.
That's right.
So question number 3 is, tell me of a time when a client might have had an unrealistic expectation of investment returns or of their retirement portfolio in general, and how did you handle it?
This is one of my favorites because a lot of financial advisors view themselves as being more salesmen, or they act more like salesmen than they do true advisors. For example, a lot of financial advisors might put a client in stocks or in mutual funds that might only pay a 2% dividend, which means that you should only be taking about 2% per year for income. So let's say you have $1 million in such a portfolio, and you're getting a $20,000 dividend or interest payment each and every year. But you call your advisor and say, I need $70,000 a year of income. And your advisor, because he's more of a salesman, says, no problem, it's your money, you could take as much as you'd like. The problem with that, Morgan, is that in that example, the other $50,000 isn't coming from interest, it's coming from principal. And I believe strongly that a good advisor needs to be willing to coach their clients and not just be a salesman, not just be an order taker, but have the courage to say, whoa, wait a minute. You really shouldn't take $70,000. You should only take maybe 40 or 50. And even taking that much, we need to make some dramatic reshuffles within your own portfolio, some reallocations.
We've talked before about protecting your assets.
That's right.
Absolutely.
That's right.
Okay, and our final question, and this seems like a pretty good one that you can tell if they're being honest or not. The question you should ask your advisor is, have you ever had a client file a complaint or a lawsuit against you? And if so, what happened and how did it turn out? So this is a biggie.
Well, it's a biggie, but the other thing that's beautiful about it is you can always determine. In fact, you can go into the meeting with that advisor having looked up their background, having determined whether or not they have any black marks on the record.
Okay.
So what I'm really looking for here is a quick answer. This more than any other place, I'm looking for a quick answer. Because as we just talked about a minute ago, you know, it's one thing to pause and hem and haw and maybe not want to give the actual answer if there is indeed a black mark, and sometimes there's not. You know, in my case, I've got over 1,000 clients, so with 1,000 clients, it's so easy to have a black mark like that one and only time that happened early on in my career. But if this person you're interviewing actually is fortunate enough not to have it, that's great. But if they do have it, you want to get that answer right away.
Right.
You want somebody who's going to volunteer honesty, because the reality of it is anyone could be honest when their feet are against the fire. You want somebody who's going to volunteer that honesty.
And that doesn't mean it's a deal breaker. It just means that they are being honest with you and they've had a very long and busy career.
That's right, and that's what you want to see. That's correct.
Well, thank you so much, David, and I mean that honestly. And I know, as usual, you have some final thoughts for our viewers.
This is fun. This is great. 3, 2, 1. But I'd like to take a few seconds and tell you why I decided to write the book entitled Return on Principle. Basically, it all boils down to this. Let's face it, you deserve to live a happy retirement. It's as simple as that. But for many, the subject of money, finance, and math is complicated. Here's a fun fact. Many Americans claim that they'd much rather clean a toilet than calculate a tip in a restaurant. Thank you, I guess. But it doesn't have to be that complicated. Using the 7 core values I outline in my book, you too will be able to build a life based upon the right core principles. Cut. Return on Principle isn't just a book about financial investing, it's about investing in your life. I know for a fact that you're going to love it. Okay, now it's just getting a little weird here. The most important thing I hope you take away from today's show is to remember the inside game. As Socrates said, know thyself, and also know thy financial advisor. I'm stressing that because it isn't something most analysts, economists, brokers, or advisors talk about. In fact, you certainly don't hear Wall Street cheerleaders talking about it either. To them, saving and investing for retirement is a one-size-fits-all proposition. And you can succeed at it by blindly following a few simple rules. Well, all of that might be true if it were only an outside game. And since Wall Street desperately wants you to believe that's true, they conveniently ignore the inside game. The inside game is where successful investing and saving really begins. It starts, again, with the understanding that your success or failure depends on who you really are, on your personality, your tendencies, your experiences, education, as well as goals. All of that. And again, most importantly, it depends upon making the effort and having the ability to be brutally honest with yourself. As I pointed out earlier, typically, not being honest with yourself doesn't necessarily mean you're being intentionally dishonest. More often than not, it simply means you're making assumptions or engaged in optimism or wishful thinking, putting too much trust in things you haven't examined as closely as perhaps you should. Remember, we're all wired to a certain extent to hear what we want to hear and believe what we want to believe. But most often, not being honest with yourself simply means you haven't taken the time to look inward. The time to ask yourself the hard questions you need to ask about whether you have the core values necessary to protect and manage your money. Questions about your focus on defense, your detail orientation, your diligence, coachability, leadership, and ultimately, fearlessness. So I strongly encourage you to make that effort, to honestly examine not only your own aptitude for the core values, but also your advisor's aptitude as well. I also encourage you to tune into upcoming shows where we'll share more tips on specifically how to measure your own core values as well as those of your financial advisor. I'll see you then, and thanks for watching.